cooking this summer. We're going to look at presidential cycles real quick, basically looking at seasonality around the first year of a presidential election. It's always worth a note, and just kind of how it's played out surprisingly accurately. And I've been showing this every month this year, and it just keeps being relevant. So I'm going to keep showing it until it's not. But you can see what typically happens from here through the summer. Typically the sell in May period, there's a reason for that. It does make sense. We are coming into that time of year. We're going to look at the NYSE new lows and how they act during the recent sell-offs. And you can see how dramatic it was, but how short-lived the drama was around the tariff tantrum. I think that was an interesting thing to look at. Then we're going to go through the current money flow stats that I like to look at, and then give you current context of where the market is and where we think it's heading. Starting off with seasonality. The funny thing is the first year of a presidential cycle, the first year of a newly elected president over the past, I believe it was 7 presidents over 25 years. Typically February, March is not great. And then you had a great rebound, which we actually did. Now, interesting, May was interesting. So the first half of May was actually pretty good. We were still doing this recovery. We only kind of got a small pullback, but we did actually get this. It was a little bit closer to mid-month. The peak was actually around the 16th, I believe, 16th or 19th. It was over a weekend. And then the market just kind of was grinding sideways until we're about here. So the historical expectation is we're going to come into weakness in the second half of June. So that would make sense. Although we've got a couple other shorter term factors that are saying maybe not just yet, maybe that pushes a little bit later. But that's going to be interesting to look at. So yeah, if we get this pullback in June, then we would expect a pretty good July and then an iffy August, September. That's like almost every year. Most years have ugly August, Septembers, usually into October, and then you get a bounce or a rally into the end of the year from November, December. Typically, it looks like it on first year of election years, the run really happens well in the first half of November. So that's something we're certainly going to be watching for and seeing how we could take advantage of it. New lows. This was interesting. There's a person named Bonnie Gortler I follow on Twitter. This is one of her charts, and it's modified. I put more things on it, but it's interesting to take a look at. And this is also inverted. When you get this chart, it's at the bottom pointing up. But I thought it was interesting because it shows number of new lows on the NYSE, right? So you see how many stocks are actually hitting new lows when things are bad, and how long they stay there. I thought that was interesting. Like back here in 2023, the second half, we had an extended ugliness and choppy sideways, and that's really what we had down here, and you can see it. And then once it finally got over, it bounced around there and stayed pretty strong and steady really in mid of last year. So the tariff tantrum, that was a pretty big, dramatic, a lot of new lows. Everyone throwing out every stock they liked and didn't like. I mean, everything got sold off for no reason, really in the second half of that. At the beginning, it made sense, and then it just stopped making sense altogether. So many good things got thrown out. But then what you can see is how quickly that all just rebounded right there. Very quickly, that was the bottom, and then we saw it come back. And when only 100 or fewer stocks are hitting lows, then yeah, the market's probably going to recover. I thought that was worth noting because we're back in this area. We're really not seeing a lot of problem, but certainly watching for spikes in this area are worth noting at this point. So I think that's kind of cool, but just how quickly this went bad, and then everything was just fine so quickly. Then you go back to 2022, which I don't have on here, and it's stayed down here for a while when you had a really ugly, a legitimately bad bear market, or one that's going to prolong its time being negative. You'll see these hang out for a while, but this was interesting, just how quickly, how deep it was and how quickly it recovered. Just an interesting thing to note. All right, back onto our typical metrics, new highs, new lows. The advanced decline is doing all right. It certainly had a good fake out there on that second rally from the taper tantrum when it tried to come up. Then the failure, it tried to retest lows and it didn't, and it failed. And then we actually had a pretty good run up until, what is that, mid-May, as kind of expected. And then really money flow has been going sideways. We're not seeing a lot of new money coming into the market, really pushing it higher. It's really just kind of a sideways grind. That's exactly what we've seen here. We go back to the chart here. Down here, you can see this is kind of how it played out. The market had a great run out of April, and then May, a little pullback, just like we said in seasonality, and then it kind of came back, and it's really not going anywhere. It really has not gone anywhere in about 2 weeks. So the market is quite sideways here. On our midterm cycle, we did get a bit of a thrust. Anytime it pushes below this 200 line, this is a variation of advanced declines. And if we get enough stocks, enough money, I think of it as enough money coming into the market to push it higher. I get a little green dot, and that actually happened yesterday. We did get a green dot. So that's usually before money starts to really push the market higher again. So that was my one caveat, saying, we could be in a spot where the market could push higher. There's early signs, but it's not a strong sign. Right? I really like to see these bigger pushes and then a more dramatic reversal like we had here and here, all these other three. But this is a little more muted. So I'm curious to see if it's just a short-lived rally, or if we can actually see this push positive. But this is really on the matter of 2, 3 weeks. It's not a long-term indicator. It just kind of helps us go, hey, we should trim some positions. Hey, we should add, and kind of give us context in that way. Major market indexes, they're all pretty good. They're all above the 8-day moving average. That's pretty positive. The only thing ugly is ILF, and I believe that is Latin America. I'm not sure why they're struggling right now, but they're the only weak. Nothing here is showing a problem except for negative on EFA is developed. International, they're starting to show a negative. Actually, a lot of these are starting to show negative. So what happens, this MACD thing is also another early warning that something could be going wrong. It's something brewing underneath the surface. Yeah, actually, all of these are negative. It's mixed on the sectors, which I'll show next. But yeah, early warnings are saying, hey, it's not as strong. I mean, it's holding up by the trend line, but there's something weak. This run is slowed, and it may be time for that pullback that we saw mid-month. We're still looking at conflicting information. The sectors, very similar. XLV Healthcare has just not done well this year. It keeps getting beat up again and again and again. And it looks like it wants to make breakouts. It just doesn't happen. But then so many sectors are on the positive side, but starting to see negatives there on technology, communications. Really, these two lead. If these two start moving to the negative sector side, then I'm a little bit more concerned about where we are. And it's interesting that XLP, which is consumer staples, and XLB, these are a little more defensive. And then XLK being technology. That's an odd mix to have trending positively in this environment. So it's really a mixed, unclear of who's leading. You know, if it were just the defensive, it would make sense because we see, okay, the leaders are taking a break while defensives do okay. And it's just this weird mixed bag that doesn't make a lot of sense. Everything is clear, it's positive, but it's not giving this indication that things are amazing. It's kind of, not sure what to do with that. And then looking at RRGs, same kind of thing. XLV here it was trying to make an attempt, and then the last couple of days, no, it just very, very abruptly reversed, because this is usually a very strong sign that we're about to shoot up and into this leading box, right? This means a positive momentum and then positive relative strength versus T-bills, versus a risk-free rate. So that's usually the setup you get for a really good run in a specific sector. And XLP did the same thing. It was looking good. It's up in the leading, and that's great, but it's just kind of stuck. And then you have all the ones that you want to see leading still down here, pointing down to the left. That's not the most positive sign, but it's not bad. They could still turn up and positive from here and push up into the leading, but usually what I expect is them to come down into the lagging box. But once they all come into the lagging box, it usually sets you up for a very, very nice rally. That's what we saw early April. They were all clustered right in this area, and then boom, they all shot up and good rally followed. So that's what we are watching out for.